नमस्कार, भार्गव ग्लोबल नेटवर्क के कार्यक्रम में आपका स्वागत है. I'm Bharat Bhargav from Washington. The mantra we just started with is Mahalakshmi Ashtakam from Padma Puran, composed by Lord Indra in praise of the divine nature of Mahalakshmi, the goddess of wealth and prosperity, apropos to our subject today. For this event, we are featuring two prominent experts in the field of finance. They are Shri Ashutosh Singh, also a member of the Vrihat Bhargav Parivar by marriage, and Shri Sahil Bhargav. They will share with us some key ideas to help simplify our understanding and managing of our personal financial affairs. In connection with our topic today, please allow me to start with an anecdote. This story is from the era when I entered the field of banking in 1972. It was in Philadelphia, the birthplace not only of the US, but also of banking in the US. An elegant, tall gentleman in a Brooks Brothers three-piece suit and a hat entered a bank branch and went to the teller, who was also in his suit and tie. After an exchange of greetings and some customary pleasantries about the weather, the customer handed over his account passbook to the teller and said, "I'd like to withdraw $100. "Sure, sir," said the teller, and asked, "How would you like the $100? The gentleman replied, "Oh, yes, 2 20s, 3 10s, 5 5s, and 5 singles. The teller gave a broad smile, seemingly impressed with the response, looked up toward the gentleman and said, "Excellent selection, sir." And the gentleman duly looked proud of himself at the compliment just received. The teller proceeded to write out the transaction in the passbook in fine calligraphy and returned it to the gentleman. Well, this story may be an extreme example, but that's not very far from the level of complexity or simplicity of banking in that era. The 70s unleashed transformational changes in banking and the entire field of personal finance. Let me take you to a rapid-fire fast forward from that era to today. The first general-purpose credit card called Bank AmeriCard was introduced nationwide and then renamed Visa in 1976. Then our bank launched a network ATM service. In 1971, US had gone off the gold standard, meaning the dollar was no longer tied to gold, and an explosion of new savings and investment vehicles followed. Given the high interest rates, market funds were introduced, money market funds were introduced, which resulted in dramatic proliferation of mutual funds. The first retail index fund was introduced in 1976 by Vanguard. IRA got enacted in 1974. 401k were enacted in 1978. The prime lending rate that had been historically mostly between 2 and 6% till the early 70s kept rising through the 70s, and by 1980 shot up to a whopping 22%, further stimulating frantic financial innovations. I have given you just a few examples of the game changers in the US. As a ripple effect, other countries introduced their own creative financial instruments. Yes, the derivatives. Derivatives are an age-old concept, but during the 70s, the introduction of new valuation techniques and the use of computers sparked a rapid development of the derivatives market. Warren Buffett called derivatives as the financial weapon of mass destruction. Well, for example, derivatives were blamed for subprime loans in the US, which ushered in a global financial crisis. Well, no matter what, nowadays we cannot imagine modern finance without derivatives. Based on this snapshot of transformation I have just offered, personal finance has now become quite complicated with a lot of choices and complexities. Hence the justification for our event on simplifying personal finance today. I see that our esteemed speakers and all the participants are here, and I invite our program chairman, Kamleshji, to commence the presentations. Kamleshji, all yours.
Thank you very much, Bharat Mama, and namaskar to all of you. Without further ado, let us see what we have. You know where you are, what you are attending. We are going to talk about money, which is going to be very educational. And the objectives of the session are demystifying personal finance and creating a framework for investment management. The discussion will focus on the following areas: understanding what personal finance means. It's about your finance. Providing simple, intuitive explanations of topics like retirement planning, asset allocation, asset class, active versus passive investments, practical advice on how to optimize your personal finances, frameworks on the investment process and portfolio construction. Remember that this is only an hour-long session. All these are big things you know. So we'll be touching on the key points. The speakers will speak for about 20-25 minutes, but then you can have your questions answered. So you can drive the discussions from there. And please write your question on the chat box. After chat box question, we will have questions from the audience. Please keep your mics on the mute. We repeat again and again. This meeting is being recorded and will be later on uploaded on YouTube. Please mute your video if you want to do so. Relax. You are richer than you think. Okay. And with that, we go on to the speaker's introduction. We have two excellent speakers, one from US, one other from popularly known as Ashu, is a CFA in New Jersey, USA. He did his MBA Finance and Marketing from Wharton School, University of Pennsylvania, MS Computer Science, New York University, and BE Honors Electrical and Electronics Engineering, Birla Institute of Technology, Science, Pilani. He was an executive director in MSCI in New York, where he was the head of quantitative strategies and risk advisory team. I don't know what that means. Please ask him if you want to know. And for alternative segments, his business crossed over 75 million. Please give some to me. Thank you. In annual revenue with 150 plus clients. His areas of research include quantitative factor models, machine learning and finance, and addition of environmental, social, and governance factors in portfolio construction and risk management. He has several publications to his credit. More, if you want to know him, ask him or go into his LinkedIn profile. Right? And the other speaker is Sahil Bhargava from our own Amchi, Mumbai in India. And he has also got a varied checkered career. So currently he's the chairman and CEO of Bharosa Club. He was a co-founder of APAC Financial Services, an Indian NBFC, non-banking financial, C stands for something I don't know, and HFC focused on MSME lending. Sahil was employee number 3 at APAC and played critical roles in strategy formation, fundraising, and launching of business lines. Post-launch, Sahil served as head of innovation and chief of staff. Sahil also served as the youngest member of the management committee at APAC. Now, before I go forward, Sahil has got a beard. In this picture, when you see him today, he doesn't have that beard. Prior to APAC, Sahil spent 5 years as an investment professional in Apollo Global Management, US. private equity team and worked on investments in education, retail, industrial sectors. An alumnus of University of Chicago, Sahil is a big believer that tough problems can be solved through focus, creativity, and hard work. Yes, hard work. Don't forget that. Managing your finances is hard work. Uh, so with that, I hand the mic over to Ashu. Over to you.
First of all, thank you. Namaste, and to people who are back home in India. Good evening to you all, and thank you very much for inviting Sahil and I to speak to you on this. What I think is a wonderful topic. Dad covered a lot. Dad Bhargav covered a lot of ground. Essentially, the history of finance from the time when he entered banking to what it is today. A lot has happened, from that time. A large part of the innovation in finance has come on the back of securitization and essentially making capital formation easier. And if you look at the history and what has transpired, that has done wonders for the world economy, reduced poverty, and essentially brought a lot of new people in the investment fold. Um, some of some of the people who are here, Kalyani, good morning to you, would sort of disagree with that by saying, look, there is still a lot of work to be done. But what I want to point out is what has transpired so far has actually made credit available to you. Some of the things that we are going to talk about has direct indication on what you as investor can do. So I use the word securitization. What is it? So this is sort of key, and it's a good idea to at least address that definition. Just give you an example. When you take a mortgage out to buy a house, the bank lends you the money, which goes to the seller who sold you the house, and now bank is out of that cash. In order for bank to be able to lend more, what banks generally do in a simplified manner will package these mortgages and sell to investors. As a result of doing so, the bank gets the cash back and it's able to take that cash and lend to somebody else. That whole process essentially makes more capital available. I don't know if, I'm not old enough, I hope so, but in olden days in India, people would actually take cash to buy big capital goods. You want to buy a car, you took a suitcase of cash and then purchased a car. You wanted to buy a house, you paid in cash. Today, when you look at, certainly in the West and in India, there is an enormous amount of credit-based economy, and that has increased people's well-being. They're able to live better, and that process also made those securities which were securitized as a result of this process available to investors like you and I to actually make purchases. So today, as Dad mentioned, from the days of just simple savings account to now your ability to invest in mortgage-backed securities, to loans, you can lend to people, you can lend to securities which are essentially backed by auto loans and so on. So a lot has happened, and that has made things much easier. The other ramifications of what transpired was globalization. Certainly from art, culture, cuisine, trade, and economy. Today, the world is much more integrated than it was today, regardless of what Mr. Trump tried to do. You are now able to invest in ideas, in assets, in various geographies, in people. And those aspects of investments have actually made a lot of progress and has increased wealth. Now, beyond, when you look at finance, and especially investment finance, and Dad and I were talking about this, a few days ago, Harsh Shastriji and I have discussed that at times, finance is a wide field. if you just look at the narrow area of investing, it can be summarized in probably in a very pithy and a succinct way. All you're doing is buying low and selling high, right? That's the principle. But to make that effective, to actualize that requires a little bit of work. So we're going to spend some time today to take you, and there are people in the audience who are very sophisticated investors. I know them, I've talked to them, and there are people who are just starting off. We will produce or at least present to you a framework which for sophisticated investors will make the process more consistent, your ability to generate wealth little less error prone, and for people who are starting off, a platform from where they can actually create a habit of investing in a proper way so your mistakes are reduced and your wealth actually grows. So you know, as I look back, and when you come to the end of this session today, my suggestion to you is, and I would like you to focus on these 3 or 4 points. The takeaways are really need to plan. And this is, you know, if there were people from military, they would essentially say, you plan in spite of the fact that you know the first contact with the enemy, that plan is going to become useless. But the act of planning is actually quite accretive in nature. It helps a lot. The second is markets evolve. Unlike physical sciences, markets are an organic, you know, ever-changing, evolving entity. The moment you know, you think you know, and this includes people like me who spend our time actually looking at market, thinking about it, analyzing it, the moment you know you have understood it, it will change. And that's what makes it fun. It makes it challenging. It makes it interesting. The third element, which I want you to remember, that like in any complex environment, a process helps. And I know there are people in the family who have essentially created a process for things that they do, and it has actually made their life more predictable. And it's not that you're going to succeed every time, but when you make a mistake, and if you had a good process, you can actually go back and see where those mistakes came from and to avoid that in the future. Finally, like any skill, learning to invest requires practice, it requires patience and perseverance. And as most seasoned investors will say, a touch of humility. That sort of provided a little bit of disclaimer, but I want to emphasize the 2 things which I would say. The opinions that will be expressed either by me or Sahil are our own. They do not represent the employers and the companies we work for. And investments in general is a complex task. Please consult your financial and tax advisors because there are tax implications. So we will begin today with Sahil. He is as Kamlesh ji said, he's without the beard, but I want to say he's a good-looking, smart, and accomplished young man. He will have some really important pointers to get started. I'll come and talk a little bit more about how to go about doing active management, and we'll define that. And we'll have fun at the end of this. Please, you know, ask your questions either in Q&A, and if you want to send chats, you can do that. If I'm speaking too fast, please let me know. With that, let me pass it on to Sahil. And Sahil, I'll move the slides whenever you're ready.
Sounds good. I think fascinating preambles that introduce the subject. I would certainly agree that finance has only become more complicated and many branched over the years. But as in many things, the more things change, the more they also stay the same. And I think that, Ashu's point about reducing complexity by having frameworks is really critical. So in my career, when I was at Apollo, we would sometimes analyze extremely arcane balance sheets, companies that were holding, very hard to decipher assets. And one of the ways that we were able to parse through them is essentially simplify them and analogize and say, what is this like? What does this look like? Can we analogize this to something we understand? And the way we were able to make progress through that was really striking. So I think the initial presentation that I'm going to focus on today is going to be very high level, because in 10 minutes we can't really, and we want to leave a lot of time for Q&A. So we want to keep our presentation short. So what I'm going to try and do is really touch on some of the things that I think are misunderstood on an intuitive level in finance across a variety of different spheres, trying to hit things that are relevant for both younger and older members of the Parivar. And so with that, why don't we get started? So Ashu, you want to go to the next slide, please? Okay, so what is the goal for today? So I'm going to focus in this presentation, and so will Ashu, on things that are conceptual in nature and not specific. And the reason for this is pretty straightforward. If we talk about a specific situation, that's only going to matter to you if you happen to be evaluating that situation. But if we talk about principles that are at a high level, it's much more applicable to everybody. And it helps build understanding and more than just, a specific, do this type of prescription. So the good news is these concepts are relatively easy to understand, but they're notoriously difficult to actually internalize and make them become habits. And this is one of the toughest things about finance. It's so counterintuitive psychologically. We tend to be very short-term in our thinking. We don't think exponentially, we think linearly. And as a result, it's very hard to understand some very core financial concepts like compounding, for example. So with that, I think this may seem simple to a lot of advanced listeners, but I'm willing to bet, because I've, made many mistakes that are in this presentation, I'm willing to bet even the most advanced investors will make some of these mistakes from time to time. So let's start with the understanding of what personal finance really is all about. So it's really simple. Personal finance is solely focused about one thing, and that's helping individuals, everyone in this room, basically attain financial independence. And so anytime you're evaluating a personal finance decision, having that lens in mind helps you make a decision. Does this help me attain financial independence or not? And if you put that framework in, it'll be remarkably easy to draw some conclusions sometimes. So what does financial independence mean? So at the end of the day, it means that you want to reach a state where your expected future investment income and any amortization of your corpus, because you can also draw down on your corpus, exceeds your expected future expenses. And why is this such a big deal? Because you no longer need to depend on external sources of income. It frees you up completely to do what you want and be free in life without worrying about how you're going to fund your lifestyle. And so that's why it has a lot of value. And so one thing that I see a lot of young professionals make the mistake of, I don't have time to focus on my personal finances. I love my career and retirement is far away anyway, so I'm not going to focus on it. And that's, in my view, not a very good decision to make, because financial independence is a net positive regardless of when you want to retire. It gives you an enormous amount of financial flexibility. You don't need to worry about if you lose your job when you have financial independence. So one thing that I really want to stress for younger listeners is start focusing on this subject early in life. Next slide, please. Okay, so this page is fairly complicated in terms of lots of text here. I'm not going to cover the whole slide. Again, I'm going to focus on some of the key takeaways that I feel are misunderstood. But I believe you guys have a copy of the presentation. Encourage anyone that's new to personal finance to go through this and really try to understand this schematic. So one of the things I want to cover here is this is essentially a diagram of the engine of personal finance. And if you look at what the raw material is that makes this engine hum, the gasoline, if you will, it is your excess savings. And this is really the sort of entry fee into playing in the realm of personal finance. And just like any engine, it runs better when you have more fuel. And so excess savings are really, really critical to getting this engine started. And when we think about excess savings, it's really the difference between your salary and your expenses. And while it would be great to wave a wand and triple your salary, it's very, very hard to do. We don't have control over our salary or our income. But what we do have control about is our expenses, right? And so what I would really encourage, again, younger people in the audience to do is to monitor their expenses. And really, this doesn't mean, be draconian and, don't, eat cup of noodles every day or Maggi noodles every day. But this means, analyze your expenses and really figure out if you're getting value for what you're spending on. And that can go a long way in terms of setting you up for financial health. The other thing that's critical here that is sometimes misunderstood by a lot of people is that this is a cycle, right? And so like anything that's cyclical, it feeds on itself. And what this means in financial terms is that a little bit of savings turns into more savings, which helps you get even more investment income, which helps you get more savings. So this is really what compounding is all about, growth on growth. And it is astonishing how quickly the power of compounding can create enormous amounts of wealth over time for people. So again, for the younger listener, getting started early is really critical. Maximizing your savings early in life gets you really, really a big head start when you work out the math, when you take into account exponential growth. So highly encourage the younger listeners to, prioritize personal finance early in their lives. Okay, next slide, please. Okay, now for some of the older listeners, a critical question that we get from a lot of our customers and members is how should they allocate their assets? And people don't really have a framework for doing this. And what we see in terms of behavior is binary sort of decision making, where people categorize themselves as either risk averse or risk takers, right? And if you're a risk taker, then I'm all in cryptocurrencies and equity and individual stocks, no debt, don't have time for debt. And if you're risk averse, then we see people say, I've got all my money in a HDFC bank FD, and a stock market is very risky, don't want to play in the stock market. And like most things in life, the answer is rarely at the extremes. And there's no accident why people don't feel like they understand how to make a decision about asset allocation. As was pointed out earlier, our choices have proliferated massively in the financial marketplace. We have so many choices of where to put our money. How do we decide? And if we don't know how to decide, then we decide on emotion. So what I'd like to do here is spend a little bit of time to give you a framework of how I think about asset allocation and how we advise people to think about asset allocation. So when you think about asset allocation, really what you want to do is match the asset holding period to your liability holding period. And what I mean by that is every asset class has a certain amount of how much it moves up and down. It's called volatility in finance speak. And it measures how uncertain and unpredictable the prices are of that asset. And the more volatility an asset has, the longer holding period you need to hold that asset. And what you want to do is look at what your expected cash needs are every year and how long you can hold various buckets of money. So what I typically recommend is you go through your corpus and you say, okay, how much of an emergency fund do I need? I need this money because I don't know if I'm going to have a health event. I don't know if I'm going to get into an accident. I don't know if I'm going to have a fire in the house. And you need a fund to help you cover unexpected contingencies. That money should be in short duration assets, right? So something like an FD is a very good place for this. Even something like a savings account may be an even better place because you don't even need to pay a breakage fee. So But other buckets of your money where you can keep it locked up and parked gives you a tremendous advantage in investing in riskier assets, something like stocks or real estate, etc. And I just want to drive this point home with this chart here. So what this chart shows is what is the chance of losing money investing in the S&P 500 for a number of years based on the holding period of the investment. Okay, and this is not inflation adjusted, so this is not real returns, this is nominal returns. And this is based on the entire history of the S&P 500, so including periods like the Great Depression, the 2008 Great Recession, the COVID pandemic, etc., is all factored into this chart. And so basically what this shows and demonstrates, if you go across the x-axis, you will notice that the fewer years you are able to hold your money, the higher the probability that you'll incur a loss between when you buy an asset and sell an asset, because you can't afford to hold through pain, right? And so you'll see that if you can only hold for 1 year, your probability of losing money is quite high, 25+%. But if you're able to hold that same asset for 10+ years, suddenly your probability of losing money, decays at an exponential rate. So the punchline here is, and one important caveat here, this is for a diversified S&P 500. This does not hold for an individual stock, right? This is a basket where there is no default risk. You're not worried about the S&P 500 going to zero, where you would be in an individual stock. But the point here is that holding power that you have in your portfolio is a tremendous advantage and allows you to play in riskier assets and turn those risky assets into safe assets. And so one of the biggest mistakes that we see people doing is they sell during a crash because they can't take a mark-to-market loss, and they look at the stock price going down 20% and they get scared and they sell, even if they don't need to. So the punchline here is having holding power is really powerful, and don't relinquish that power by selling and when you don't need to, in assets where you can hold that are diversified and you're not worried that they're going to go out of business. So next slide, please, Ashu. Okay, another thing that we see a lot of investors struggle with is, should I be picking individual stocks? Should I be investing in individual properties? Or should I be investing in passive investment vehicles like index funds or diversified mutual funds or ETFs? And it's really a spectrum. And I have a point of view on this. I've worked in active management for many years. So at Apollo, and then also at a hedge fund where I invested in US equities. And what I'll tell you is that it is extraordinarily difficult to beat the market. This was, our mandate as a hedge fund was to long short equities, was to beat the market. And it is astonishingly difficult. And this was a 24/7 job for me. I was basically always thinking about stocks, and do I think it's possible to beat the market? Yes, absolutely. I do think it's possible, but it requires a lot of work, a lot of research, and it's extraordinarily difficult. The good news is that you can do just fine investing in passive instruments. And actually, Warren Buffett took a bet where he bet a gentleman that the S&P 500 would beat the average hedge funds index performance for 10 years and over a 10-year period. And he recently won that bet. So passive tends to win on average when you factor in fees and whatnot. But who may benefit from an active investment approach? Some people enjoy it, and if you enjoy it, then do it by all means. It's something that you like. And the point is that even if you're investing passively, this doesn't mean you basically can just set it and forget it. You still need to monitor your asset allocation. You still need to make sure that the asset allocation matches your liability profile. You still need to, monitor your portfolio. So a passive investment doesn't mean, just set it on autopilot, but it means you don't need to pick individual stocks or individual investment options. You can pick diversified options and do just fine. So with that, I'm going to turn it over to Ashu, who's going to talk more on the active side and what you can do to manage your portfolios. Ashu, you're on mute.
Sahil, thank you very much. That was excellent. Yes, the takeaways are you can do quite well by using index funds, ETFs, which are diversified and are low cost. So when we are talking about investing in general, what are the three things that we need to focus on? We start off by actually understanding where we are financially in our life, in the sense that what is the picture of wealth that we currently have? What assets do we have? The next step is making investments. And third is to monitor, manage, and rebalance. These are the three parts to investing. It's sort of a broad brush process associated with that. A few things to note about investing in general. It can be hard and painful the first time when you do it, because you have to actually sit down with your lovely wife or your husband and do a catalog of what assets do you have. And it's generally a very painful process. The next thing is you need to reassess this exercise. You need to rebalance and look at your portfolio regularly. And it could be once in a year, it could be once in a quarter, but it all depends upon what your openness to doing something like that is. These three steps that I'm going to talk about are quite integrated. One feeds into the other. If you don't have a good sense of where you are, then you do not know how much risk you can take in your actions. If you don't rebalance your portfolio regularly, then it may get out of line and may not meet the asset liability equation, the calculus that Sahil touched upon. Because at the end of the day, what you're trying to do is make sure that you're financially well off. And in order to do that, you need to know where you are and where you want to go. Okay, so to understand where you are, we touch this a little bit, and to have an easeful, sort of a less stressful life, it's almost like you can actually do that. And the joke is, yes, Virginia, there is Santa Claus in this space. The goal is that and I would say one thing, and this is something that happened, I think probably about 2 years ago. A colleague said, Ashu, you're going to live to 120 because I'm vegetarian, blah, 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 and so on. And I sort of said, then I have to work till I'm 90. Because in order for me to actually live till 120, I need to make sure that money does not run out of before life. So as Sahil said, knowing where you are, what your goals are is pretty critical. The next thing within that sort of rubric is your risk appetite. And this includes things like how old you are, how do you react to surprises, both personal and financial, your ability to maintain a sense of calm when markets are going haywire is very critical. There were times in 1987 when people actually jumped out of the window because they were highly leveraged, and when markets fell by 25%, they were wiped out, and people actually took some extreme steps. So we need to understand what our risk appetite is, how much risk can we take. When we talk about financial assets, we look at some which are, as I have listed here, some are quite liquid, bank accounts. Sahil talked about that. There are your pension and social security. It's going to become available to you once you reach the retirement age. Your stocks, bonds, your house, which is a big asset. Some of them are liquid in the sense you can cash them fairly easily without that much of friction. And by friction, I mean that if you are selling an asset and you have to sell at a fire sale price because you need to generate cash and there is not enough market for it. That is sort of creating a friction. And you want to make sure that you have enough liquidity in your portfolio. You might have some private investments. You might have invested in some private company. That is something which is not very liquid. So get an andaz of your book, of your portfolio. How long, you also need to know how long do you plan to accumulate wealth and work? Because if you want to work for another, say, 10 years and you are, say, 40 years old, you need to start planning accordingly. How much do you need to save, and how much do you save regularly, and what are your expenses? So get a sense. You also have to have a good understanding of what your health conditions are. That is, if you have any family history of chronic diseases, what your insurance look like, and then what do you want to leave behind? You might have children, grandchildren, and some people want to leave some money behind for them. Finally, taxes. I mean, you can't forget Uncle Sam, Modi Bhai, they all are going to stand there with their hands stretched out. They want their cut. So this is probably the most interesting part. Now that you know how much you have and how much you can actually invest, let's talk about investment and risk management. These two things go hand in hand. Just like when you're working, you're trading your time, your skills for money. You get paid because you are skillful. You get paid because you are putting in some time. Investment returns are a payment for the risk that you are taking. So next question is, what is risk? Well, Sahil talked about one way to look at risk is at a broad level, the return of capital. And I'm choosing my words very carefully. Return of capital. You're often looking for return on capital, but the big risk is you invested something and you don't get your money back, or you don't get the return that you want. Formally speaking, and when I say formally, from a certain perspective, any outcome that is away from the expectation, this is statistically stated, when an outcome is away from the expectation, that creates certain uncertainty and volatility. So your next question is, if I'm making an investment, am I getting compensated for that risk? And these concepts, especially in active management, something which Sahil spent his time at Apollo and hedge fund, and I spend my time today and in the past for last 15 some years, is really looking at, am I getting paid for the risk that I'm taking? So now that we talked about what is risk, can we measure risk? Can we get a assessment of the risk? One way to look at risk is how much volatility is there in that asset that you're buying. Now, not all asset classes have the same concept or the driver in terms of risk in the same way, but by and large, in equities, especially in stocks, higher volatility means higher risk. And when a stock has higher risk, its expected returns are going to be lower. And there are reasons for it. Things like leverage effect and so on. We're not going into the actual finance aspect. But when a stock has higher volatility, then it has got higher risk. The drivers of risk for different asset classes can be different. For equities, by and large, it's the volatility. And one way to measure volatility is the beta of the stock. And I'm going to talk about that in a second. For bonds, it is the government policies, interest rates, credit conditions, economic cycle, where we are has a big difference. People have been talking about Fed should be, removing the economic stimulus. And that has, for some time in March, people were quite worried. And the interest rate, 10-year rate went from whatever 1.4 to 1.7. It's back down to 1.3, or it's trading in a very tight band there. Commodities. they're largely, the risk with commodity is really the supply and demand. If there is drought, then you don't have that much output in corn and wheat, and the prices are going to go up. Same thing with hard commodities like copper, silver, or rare earth metals. These are all sort of a function of supply and demand. Now, last time when I talked to somebody about beta, they said, I have no idea what that means. I'm just going to make it very simple. Higher beta means higher risk. And what is that beta dependent on? If you look at the goods and services that we consume, things like clothes, or you buy gasoline, or you buy washer and dryers, the things that you buy they are produced by companies, and these companies essentially get paid for producing these products. Their sales of these goods and services are in some cases a function of the economic cycle. They're called cyclical stocks. So if the economy is roaring, people are going to purchase more stuff, and these companies are going to sell more stuff. Those stocks are going to go up. They are in essence a function of economic cycle. There are other stocks, things like utilities, like your gas in the sense your petrol that you put in your car, or electricity. These are less a function of economic cycle, because you're going to buy food, you're going to drive your car, you have to get to work. So these are called defensive stocks. Defensive stocks have lower beta than cyclical stocks. They are generally higher. Now, I know it's very likely that some of you would say, wait a minute, Ashu, I looked at Google and Apple's and Amazon's beta. They are all about 1, or they are less than 1. Why is that? They are technology stocks which are cyclical. How are they different? These big 5 companies, Google, Apple, Amazon, Facebook, and Microsoft, they have become, by certain measure, a defensive sector of its own, because they are so large and they are so integral to our day-to-day life. So,
Ashu, we are at about 50-minute point total. So however you are planning to, of course, your main messages have to come through. So however you want to do that, I just wanted to give you an idea. Kamlesh, if you're thinking some other way, let me
take
Thanks,
5
Mama.
minutes and I'll conclude
Sure.
this piece.
Yeah.
Okay. So how do you reduce risk? Sahil talked about asset allocation, which is very critical. Margin of safety is another piece. We can discuss that in Q&A if you like, or by diversification, which we also talked about. What I would say is, when you are making an investment, look at after fees return. We talked about cheaper alternatives to invest, like ETFs and ETFs and index funds. They are much better. They are lower risk. And finally, because somebody had asked a question about using options, I would say this, that if you are selling naked options which are not backed by some holdings of yours, or you don't have enough cash in case your option gets exercised, then you are taking huge risk. These are called negative convexity trades, and we can discuss that in Q&A, which are very risky. Finally, in terms of the third step, it is important that you are monitoring your investments more regularly, or regularly, I shouldn't say more regularly. You're monitoring your investments regularly. You need to be able to understand that when you succeed or fail, is it because of luck or skill? The more you understand that, the better you're going to get in your investment process. There's one thing which I would say about this, and in the next slide, it's going to come through. The best way to get your investment skill better is to keep a record of what you invest in, why you are investing in, and what is your expectation. And the detailed record that you have, the better you're going to get over time. Just my final thoughts about investing. Keep your position sizes less than 5% of your investment portfolio, because that way you're not risking a huge loss. A good stock may not be a good company, and vice versa. A good company may not be a good stock. And then, it's sort of said very well by either Buffett or somebody else that the value is what you get and the price is what you pay. So there is a big difference between understanding what is the valuation of a company or the asset that you're buying. Too much trading is not the same as investing. People are, there are the brokerages which allow you to trade very frequently because at zero cost. There is a hidden cost there. And we already talked about keeping a diary of your investment decisions. So just sort of recap, we talked about the 3 steps. We talked about the fundamentals of investing. And yes, this is our 50 minutes. Dad, thank you for in 50 minutes. This is our gist of the presentation. Hand it back to you, Kamlesh ji.
Thank you very much. Can you switch off and share? Stop your sharing. Okay, so that was some easy stuff, some heavy stuff. But we all know, and most of us, I think 90% of those people who are attending, always worked and got money. Now, the concept here is making your money work for you. Both require efforts. It's not that if you money would just grow. Of course, the first question I would like to ask Sahil and Ashu is, I don't want to get into all this jargon and complications, etc. I just want to invest in S&P 500, or in India, it's Nifty 50 or Nifty 100. And how much returns over a period of time historically do you get?
So S&P has returned on average, when you look at long history, about between 10 to 12%, somewhere around.
Okay.
Right.
So, Ashu,
but if you're taking a risk, just want to give you a sense, the risk of S&P is about 15-16%. So it's about less than 1 Sharpe ratio, but it's around there.
Okay, but then, right. And what is the return if you put your money in the bank and just get, see what in India they call it fixed deposits or CDs in North America?
You are getting today somewhere in less than 1%.
So
or around 1%.
Yeah. And around 4 in India.
As one of my cousins, Sanjay, says, in India, they have this called as FDD, fixed deposit disorder. And the same thing applies here is you can get either 1%, or if you take a little bit of risk, and S&P 500, I would consider it as safe. You get 12%. Just think about that. So with that, let's open up to questions. Some of the questions which were posted at the registration time were how to plan investments on the Indian bourses. There are many Bhargav-owned firms advising on wealth management. I hope the event will add value to them. And specifically was asking about equity versus debt funds. Any thoughts on that?
Yeah, so, I guess fundamentally just understanding the delta between equity and debt. Equity is basically being a participant in the business. You're a partner of the business. And so if the business does well, then you also get the upside. And if the business does badly, then you also get the downside. Debt is, very much a binary situation. Either you get paid back with your interest, or the person defaults and you're trying to recover your money. So if you think about the orientation of those two instruments, with debt, you have a very high visibility of what your return is going to be if you hold it to maturity. That is, you hold it for the length of the loan, and you don't sell it early. You pretty much know what your upside is, right? And your downside is very unlikely if you're lending to a good credit, someone that's going to pay back the loan. With equity, it's very uncertain. So Ashu mentioned the long run returns, but in any given year, he mentioned the standard deviation also of 16%, right? So in any given year, it could be minus 20%, it could be positive 40%. You don't know, right? So really the question of how to manage your money between asset classes like equity and debt is to figure out how much of your money can you put in an asset class that is volatile like equity. So that in equity, there's a risk from year to year that you may lose a lot of money, right, on paper. But if you don't have to sell, right, you can ride out that volatility and do fine over a long period. And my rule of thumb is I think of equity as a 10-year plus asset. Okay, so if you can keep your money parked in that diversified fund, right? And the big asterisk here is it's a diversified fund, not one stock or a sector fund or something like that, but a broad index.
So, thank you very much, Sahil. We'll move on to the next question. Why the share market is booming when the economy is going down, especially during the pandemic?
Sahil, you want me to take that?
Sure.
So one thing we have to remember, equity market is generally based on expectation for the future. It is, and within the equity market, there are some short duration plays and then there are long duration plays. Technology is a long duration play in general. What Sahil mentioned, that when you're investing in equity, you are investing for 10 plus years. In bonds, it's a shorter term investment. Same way with the value stock. Value stocks are generally based on reversal to the mean, reversal to the actual value of the stock. It's a shorter term play. So short answer is markets are based on expectation, and if the expectation of Indian market is it's going to grow by 10%, that's IMF's latest forecast, 9.5%, then that's what the market is essentially pricing.
Okay, thank you. There was another question. As young professionals, what is the best way to be financially prepared for quickly approaching life events like down payment of a house, growing family, children's education, etc.?
So I can couple of things. One, save as much as you can. By watching your expenses. It's relatively easier to save money when you're younger, when you're not married and don't have kids. So that's number one. Number two is build your credit history early. Get a credit card as early as you can, and pay that credit card back in full every month. But just doing that, you're building a credit history. So when you need a loan, you can get an attractive interest rate on the loan.
Okay, thank you. Now, one thing I wanted to say was, everybody loves your money, especially investment advisors. So is there some way, because I'll just give you an anecdotal history on which I do. I'm a doctor basically. So when I go to the bank and they say, okay, meet this investment advisor, I'm yet to find, and Ashu and Sahil, you can guide me on that, an investment advisor who will take my money, invest it, and get paid when I make money. So if I say I want 10%, if you make 12% for me, I'll give you 1%. Are there investment advisors like that, who make money after you have made your money, not they make money whether you win or lose, that is immaterial?
That trend is beginning to emerge, especially in the institutional investment space, where there are hedge funds who have come up and said, we will get paid only performance fee. And that is also after the high water mark. It's not very easy for retail investment advisors to get to do that. If you want to have an advisement, let me put it this way. You can do a lot on your own to not have to pay that fee. And somebody asked a case of robo advisors, as long as you follow the process that we have outlined, if you want to discuss more, we'll be happy to discuss more. You can actually do a lot on your own and don't have to pay the fee.
Yes, I love that point. You can do a lot on your own. I'm doing it on my own. It's only a question of you do have to work hard and learn and attend sessions like that. There are plenty. You need to learn and on your own. Okay, so what is the difference between growth and value stocks?
So, Sahil, you want me to take that, and you can chime in. So,
Yep.
the value stocks are the stocks. Leave aside the metrics by which we compute value versus growth, or value or not value. Value stocks are the ones which are mispriced versus the underlying value of the company or the asset. Right? What is a equity? And Sahil touched on that. Equity is an option, is your bet that the company's assets are going to grow. That is your expectation, and that's why you're invested in the equity space. Growth is a long-term expectation. If you invest in a technology stock, what you're thinking is what this company is working on today will become actually a very good product in years to come. That's the growth stock. A value stock is something which is not priced correctly and will get sort of adjusted very quickly. It's a shorter duration.
Thank you. So now, Sanjay, if you can in 1 minute tell us what you want to say about FDD, the term which you have coined, the fixed deposit disorder. Sanjay, are you there?
Yeah. So I'll be very brief. So the thing is, just like in medicine, you have diabetes and you have heart disease. So similarly in financial, if you have fixed deposits in India, I think you're suffering from a disease. That's not to say that you don't have safe money. You need safe money, but for safe money, there are better alternatives like overnight funds, ultra short debt funds. So I would just say that just take it from me. I've studied this. There are also tax consequences, etc. Please research this on your own. But believe me, if you have, unless you're an 80-year-old widow or a widower who doesn't have children, who can't manage things for yourself, and you're used to fixed deposits, and you don't want to change, for everybody else, even having 1 rupee in fixed deposits makes no sense. And I'll stop at that.
Thank you very much. That was a strong statement and right from the heart. That's good. So there are 2 more questions or comments. So one is there are many funds, and Warren Buffett is the first one. Rakeshji, I didn't understand what you meant.
What I meant was that there are many funds to add to Sahil and Ashuji's point that like Warren Buffett, when he started, he would only make money after you have made money, to answer your question. And one of the other fellows, Mohnish Pabra, he does the same thing. So that was a comment, not a question. The question is after that. Thank you.
Okay. Thank you very much for letting us know that. The question is how important fundamentals in selecting stocks today. So looking at all the charts and the numbers and values for the past 5 years, 10 years, how important is that? Or do we just rely on the Morningstar report or some other report?
So I have a perspective on this.
Yeah, go ahead.
Ashu, you want to go ahead?
Both can give a perspective. First Sahil and then Ashu.
I was simply going to say this, that yes, look, I understand, Rakeshji, that market is driven a lot these days by sentiment and the central bank action. I get it. But as Mohammed Alarian said probably a few months ago, when I'm not going to use the word, when things hit the fan, people will revert back to the fundamentals. People will immediately, the fundamentals will come into the frame. So you can't ignore the fundamentals, but yes, momentum is, or sentiment is, which drives the stocks in the short term. And you want to understand the fundamentals to see, are you, it's more like when the tide goes out, you will find out who is swimming naked, right? And it's really that. I mean, I hate to use those phrases, but it's true that if you are just betting because your brother-in-law told you that, then be careful.
No, but Ashwiji, the reality is that market can remain irrational longer than you can remain solvent. So how does one deal with it?
Absolutely true. You are right, and that's the reason why you have to be careful when you are investing simply based on sentiment. And cryptocurrencies are classic examples of that. Man Group, bunch of people have essentially said that they cannot find an underlying valuation metric for these stocks, right? There is no way to value these stocks. How are you going to assign a certain, like, am I paying too much or too little for it?
Right, thank you. So we have quick three. We have run over time. Okay, go ahead, Sahil.
Yeah, real quick add on to this. I think the answer to that question really depends on the position size and how diversified your portfolio is. It's totally fine to select stocks at a high level if these are minor positions and you have a well-diversified portfolio. You don't need to crack open a 10K and do tons of research on it or an annual report in India, but if you're taking a sizable position in something, then you just should, I operate with the rule of, what would I do if the stock went down 20% the next day? Would I have enough conviction in my analysis to know that this is still a good idea, or would I panic and sell? And that'll be a good heuristic to use whether you've studied the stock enough, because that happens all the time.
On that count, Sahil, depending on individual's risk capacity, you can preset and define on, if you're doing it online investing, that if the stock falls, say you say 5%, it will sell off. So you cut down your losses. You don't wait till 20%. You can define 2%, 3%, 5%, whatever it is. And then you learn you can only lose a certain amount. So, and the next question was specifically for India, based on recent economy, which sector is likely to give better results? Share market or bullion or real estate? And in the share market, I'll just give a pointer. I would prefer the pharmaceutical industry. And over to you, Sahil.
Yeah, so this is a $1 million question, because if you knew the answer to this, you would be more than a millionaire. You would basically borrow money and put money into the sector and make tons of returns. So please take this with a huge pinch of salt. The only thing I will say here is that, look, there's a case to be made that equities are overvalued, but from my vantage point, I think real estate in India is it's very hard to find a economic justification for the asset prices in the real estate market in India. The rental yields are that rental yield is how much rent you can collect versus the how much you can sell a house for. You can make more money investing in FDs, even though my father Sanjay hates FDs, as you heard. You can make more money investing that money in an FD than renting out your property. That to me is an equation that doesn't make sense. So I would avoid real estate personally. I think equities in the long run, you'll do just fine.
Okay. Thank you very much. So
yeah, if I may just add one thing here, very short.
Go ahead, Sanjay.
So the thing is that if you believe that India is going to grow, right? So then, equities are a way to become desh ki tarakki mein hissedar. Okay. So, then equities are a decent class. Real estate also, but the problem with real estate is that if you compare real estate prices, say in Mumbai with Manhattan, the prices in Mumbai are higher than Manhattan, which to me does not make any sense, right? So it's and the rental yields are low. So that is worrisome. But on Indian equities, Indian growth, I'm a little more positive.
Mm-hmm.
Agree with that.
So we'll take the last two questions. What's the best way to invest in liquid funds or other FD alternatives as an NRI? Do you have app website recommendations?
I have not studied this, so I don't want to give a view. Papa, do you have a view?
I can answer this.
Okay.
Yeah, go ahead, Amita.
Can I take it?
Yeah, go ahead.
So
Anita.
it depends on which. If you live or the US, unfortunately, there are not too many mutual fund houses which let you do a paperless transaction. Okay. Nippon India and Aditya Birla were two fund houses where you could do it paperless. Because there are certain rules which are specific to North America, restrictions. So if a person said that they live in Dubai, there's no problem. You can go on to any mutual fund. Let's say you want SBI or anything, or you could choose mutual fund utility, which is was set up by all the fund houses. That's where you can get everything.
Yeah. Thank you very much. Yes, I myself, as an NRI, have been doing it with both Nippon and Aditya Birla. But it's up, the choice is yours, because you have to take into consideration the currency for fluctuations, which is more now, etc. So you do have to do your due diligence. So the other question
also,
is...
sorry, can I just, this is an exception to what I said on fixed deposits. So for NRIs and people living in the US, there are the FCNR deposits and so on and so forth. So which banks promote, and I'm sure all of you are familiar with. So to get better returns than what you would get in the US, these might be good options. And you can remove the foreign exchange risk or take the foreign exchange risk as you choose. There are also ways to invest in Indian equities, like you could open an account directly with Zerodha instead of getting going into an Indian ETF. So these are all various, but they're a little complicated, So again, my basic thing, like we said in this theme, was that start with small money. So go into the shallow end of the pool, not the deep end, and keep learning and do then whatever works for you.
Mm-hmm. Okay, so the last question we have is, how can we invest in India? What returns can we expect in low risk assets? This, of course, I think Subhash Mama, who's an NRI or overseas OCI, easy investment and withdrawal. Can we withdraw the money easily is the key. Any thoughts, Anita or Sahil?
Sure, I can answer this. Yes. Like I said, setup is a little difficult if you're an NRI. I mean, there's certain things that you need to do. If you, in certain cases, you will need to upload a bank proof of the transaction that you made. So there are added complexities with being an NRI, especially if you fund it through certain kinds of accounts, but they can all be dealt with. So,
Yeah. Okay, thank you. That brings us to this excellent session. It gives us a point to think about, and things are complex, but it can be done, especially these days with internet and e-access and online banking. You can do it from the comforts of your home. And if you have made use of the pandemic so far, you could be doing it, because during the last 1 year, S&P 500 has gained 30% even after falling in. So points to think about. So over to you, Bharat Mama.
Great job, guys, Ashutosh and Sahil, and of course Rakesh for conducting it. Keeping promise to people in terms of the overall schedule. We have effectively liquidated one of our breakout sessions because the conversation was going great. The questions were coming very nicely. So it was worth it when we have these two experts on hand to take advantage. We will still have one more breakout session. Hopefully our speakers will be there. They'll show up in any of the breakouts. And also after that, the plenary. Before we start the breakout session, I want to let you know, please respond to a short survey that you will be receiving after the whole event. We meet again on October 3rd, every even month of the year, usually the first Sunday. So that will be on October 3rd, when our presentation will be on artificial intelligence, recognizing that AI has taken off, affecting so many things in our lives in a big way. This event will be a good occasion to know what AI is, and how we can benefit from understanding it conceptually. In the meantime, have a great Independence Day, Raksha Bandhan, and Janmashtami to you and to your families on behalf of the entire BGN family. आपको इस कार्यक्रम की शोभा बढ़ाने के लिए बहुत-बहुत धन्यवाद. It's been a pleasure chatting with you. I turn over to Arvind ji for beginning the sessions. Namaskar.